Hello, everyone. Today we are going to break down the $150 trillion global bond market. Yes, you heard it right. It's a trillion with a T. We'll try to keep things simple and cover what are bonds, who issues them, who buys them, how do they work, and what you should consider before you decide to invest in this. So do listen in if you are considering investing in bonds or are just generally interested in the topic. First off, let's start by understanding what exactly is a bond. Putting it simply, bonds are just like loans. Think of it like this. Imagine your friend comes and asks you to lend him $1,000 so that he can go and buy the latest iPhone. They promise to pay you back in a year, plus an extra $50 as a thank you for the loan. That's bond in a sense. The amount your friend borrowed from you, the $1,000 in this case, is the principal. The $50 that he promised to pay you back is the interest or the coupon, and 1 year is the duration. Best of luck getting it back in 1 year. A bond is basically an IOU, a formal loan where someone borrows money from an investor and agrees to pay it back after a set period of time, with interest along the way. The borrower gets the cash upfront, and the investor gets steady payments in return from the borrower for using their money. It's not like stocks where you own a piece of a company and prices swing widely. Bonds are more about reliable income. Bonds are generally issued by organizations that need to borrow large amounts of money for long durations. The main issuers are governments. In fact, the US federal government is the largest issuer of bonds in the world. They use this money to fund big public infrastructure such as building roads, schools, healthcare, or defense and security. These are usually considered to be super safe investments because they come with a sovereign backing, and governments can usually pay back by imposing new taxes or printing more money, which may drive inflation, but that's a topic for another day. Second would be large corporates who issue bonds to grow their businesses. They may use the funding for new equipment, facilities, or launching new products. You may ask, why not stocks or bank loans? Bonds ensure that companies don't give up equity control, like is the case for stock, and offer longer and cheaper terms when compared to banks. And finally, local government like cities or states for community projects like parks, hospitals, or bridges. In short, issuers use bond to get cash now and pay it back over time, preferring them for flexibility and cost over equity or short-term bank loans. But who provides that cash? Let's flip to the other side. On the buying side, it's anyone who's looking to invest their money for predictable and consistent returns. Buyers include individuals who may be looking to save up for retirement or earn more interest than a savings account. Unlike the volatile nature of the stock market or illiquid nature of the real estate market, bonds offer steady returns and ensure access to your money while helping you diversify your portfolio. Because when stock markets crash, bonds often hold steady and act like a good safety net. Secondly, big institutions such as pension funds, banks, or insurance companies who manage huge sums of money and want stable, low risk investment to protect their capital while ensuring consistent returns, helping them meet their long term obligations. And finally, governments. Asian giants like Japan or China hold a significant amount of US Treasury bonds to invest their reserves safely, earn interest, and manage their currencies. Buyers are essentially lenders betting on getting paid back with interest. With players set, let's see how all this operates in practice. Ever thought of investing in bonds? If yes, let's understand how they work. Bonds usually have three key parts. First is the principal. That's the amount you lend, which is often called the face value. Second is the interest or coupon, which is paid out annually or semi annually. Third is the maturity date. That's when the loan ends and you get back your principal. This could be anywhere between 3 months to 30 years. You can buy fresh bonds on the primary market or tenured bonds from the secondary market. Prices do fluctuate. If interest rates rise, older bonds with low rates might sell for less. But if you hold on to maturity, you still get the full principal. Importantly, there's an inverse relationship between bond prices and yields. If rates go up, existing bond prices fall to make the yields more competitive, and vice versa. Bonds aren't one size fits all. Here are some key types based on the features. First, convertible bonds. These can be turned into company stock at a certain point. Great if you want bond safety with stock upside potential. Next, we have zero coupon bonds. No regular interest payments. Instead, you buy them at a discount. $800 for a $1,000 face value, and you get the full amount at maturity. This difference is your interest. Then we have inflation protected bonds. These adjust for inflation to protect your purchasing power. And finally, we have callable bonds. The issuer can pay them back early, usually if rates drop, which might cut your interest short. Pick based on your goals. Zeros for tax perks in retirement accounts, convertibles for growth. To wrap up, bonds reward you with steady income, lower risk than stocks, and portfolio balance, making it perfect for long term goals like retirement. But do look out for the risk associated. Interest rates changing can affect prices if you sell early, and inflation might erode value. If you're intrigued, start small. Buy US Treasuries directly via treasurydirect.gov or use brokerage platforms. It's low pressure investing. Thanks for your time. If there are any questions you want me to explore further, please do drop it in the comments and I'll try my best to take them up. And if you have stayed till the end, don't forget to like, share, and subscribe.